Welcome to Reverse Mortgage Radio, hosted by Legend's very own reverse mortgage professor, Bruce Simmons. You have so many options with a reverse mortgage, everyone has a different opinion, and the government keeps changing the rules. You need to hear from the first certified reverse mortgage professional in Colorado to specialize exclusively in reverse mortgages, one of few in the state with the letter CRMP after his name. Bruce has the specific training and education you need to understand what you're buying. Now, here's your host, Bruce Simmons.
Hello. Welcome back to another episode of Reverse Mortgage Radio. I'm your host, Bruce Simmons, your reverse mortgage professor located right here in beautiful Colorado. Let me ask you something real quick here. We're going to start with a question. Have you ever wondered if you would qualify for a reverse mortgage? I hear this question all the time from homeowners. Bruce, what do I need to do to qualify for a reverse mortgage? Do I even qualify? Well, today I'm going to answer that question for you in good old-fashioned plain English. All right? We're going to dive into that, and there's really just three big questions that we need to determine if you qualify. Number one is your age as well as your spouse. So we factor in the age of the youngest homeowner. How much equity do you have in your house? And then also there's something called financial assessment, which is basically just a checkup on your income and credit. Yes, we do factor in income and credit. You have to qualify because we want to make sure this is sustainable for you. We don't want to do something that's just going to put you in a worse position a year or two or three down the road. Now, we're going to take each one of these step by step, and by the end of the show today, you'll know exactly where you stand. Also, you could just give me a call at 303-467-7821. That's my direct number, 303-467-7821. I've had that phone number since 1999, okay? I'm not going anywhere. I've been specializing in reverse mortgages since 2022, since 2003 for 22 years is what I meant to say. I kind of mixed it up. But I've had that phone number since 1999. It's a business line that rings to an office in my house. So that's the best way to reach me. But you can also visit me online at reversemortgageradio.net. reversemortgageradio.net is my website. You can go there and download a free consumer guide. That's an awesome way to gather basic information. You can also click on the link to the upper right-hand corner to get a free quote. See how much money you qualify for right off the bat. Now, that doesn't mean you'll qualify if there's enough to pay off your existing mortgage and have some money left over. That does not automatically mean you qualify. That means equity-wise, you probably will qualify. Of course, it depends on the value of your home, what the appraiser says, and all that. But before we get into the meat of the program today, I do like to quickly go give you an overview of what a reverse mortgage is. Most of the time, a reverse mortgage is an FHA-insured loan. FHA stands for Federal Housing Administration. So this is a government-insured loan. The loan is not from the government. Okay, but they set the rules up for us, and then they guarantee to the lender that they're going to get their money, and to you, the homeowner, that you're going to have the money available to you when you need it. If you choose to receive as a monthly payment to you, or if you set up a line of credit, that money's guaranteed for you to receive it. Okay, but basically, it is a loan that allows you to convert a portion of the value of your home into money that you can access. Because right now you've got all this money tied up in your house, but you can't spend it unless you convert it to cash. That's what a reverse mortgage does for you without requiring you to repay it. As long as you live in the home, as long as you pay your property taxes, you pay your homeowner's insurance and any other property charges like HOAs and things, you maintain the home and you keep your name on title. That's the fifth one. You do those five things, you never, ever, ever are required to make a monthly payment. The house is still yours, still your house. You just have to pay your taxes and insurance, live there, maintain it, and keep your name on title. As long as you do all that stuff, you're good to go. you're still charged interest every month. You have to be aware of that. And I make that very, very clearly when we meet or when we talk on the phone. You are charged interest on this loan. It is a loan. It's a reverse mortgage loan. Every mortgage is a loan against using the equity in your home as security or the value of your home. We determine the amount we can loan based on the value of your home. Okay? That's the quick lowdown and dirty in a nutshell, how it works. Now, let's touch on the first thing that we talked about. That was your age. That's the key factor, one of the key factors, one of the three. Let's start with that. That's an easy one. To qualify for the FHA-insured reverse mortgage, which is also called the home equity conversion mortgage. That's just the name of the FHA-insured loan. There are other reverse mortgages that are not FHA-insured, and those loans are called all kinds of things. There's Home Safe, there's Platinum, there's SmartFi, or Home Choice, all these different kinds of names. The one we're focused on today, because it's the most popular by far, about 95% of the loans in Colorado are FHA-insured loans called home equity conversion mortgages, or HECM is what we call it. But for the HECM, you have to be at least 62 years old. Now, if you're not 62, you could possibly still qualify for a non-FHA-insured loan. Those are called proprietary loans, those with all those other names. But generally speaking, it's called a proprietary loan, and they're not FHA-insured, but they allow you to go down to age 55 is all you have to be for that, okay? But most of the time for the FHA one, which is usually the best program, and if you can wait, it's usually best to wait. But the FHA-insured one, the HECM, is the best program. You have to be, one borrower has to be at least 62, okay? Now, if you're 62 and your spouse is, say, 57, whatever, you could still do the reverse mortgage, but you, being the 62-year-old, is the only one that's going to be considered a borrower. Your spouse can continue to stay in the home, obviously, keep his or her name on title, but they're considered a non-borrowing spouse. They're still your spouse, obviously. They're just not a borrower. And there's certain rules around that I'll get into in just a few minutes. But here's a quick example. Let's say that John is 65 and Mary is only 60. Now, if you call me and you're in that situation, I'm going to recommend you wait till you're both 62. It's just better that way. But we can do it with just 60. So John can take out a reverse mortgage. He's the only borrower, but Mary's still protected. She can stay in the home and her name stays on title. And even though she's not 62, however, like I said, she's not a borrower. Under normal circumstances, if both borrowers are over 62 and one passes away or has to leave the home permanently, then the other spouse, whoever stays in the home, can stay there, and they have access to all the money that's available. The loan will only become due and payable when the last borrower, and I want to emphasize that, the last borrower permanently leaves the home. Now, in the case of a non-borrowing spouse, though, if the older person, who is the borrower, if they die or has to leave the home, in that case, the loan does not come due. The non-borrowing spouse can continue to stay in the home, but they will not have access to any funds at all, and they have to continue to pay the property taxes and insurance and live there as their primary residence and all that. But because they're not considered a borrower, if there was money left over in a line of credit, or if the borrower was receiving monthly payments, let's say they're getting $1,000 a month and they die, well, now the borrower is not in the house anymore, so all the money stops because the non-borrowing spouse is not a borrower. And in that case, the money just stops. As long as the non-borrowing spouse keeps his or her name on title, lives there as their primary residence, pays taxes and insurance and maintains the home, the loan will continue. They just don't have access to any more money. Okay, so that's the first building block is age. It's pretty straightforward. Now we're going to go to the second factor. And this one's, I would say, a little more flexible about how much equity do you have in the home, okay? Now, first of all, I want to be clear. because equity, some people don't understand what equity is exactly. Equity is very simply the value of your home minus the amount you owe against it in all loans. If you've got a first and a second mortgage, or you've got a first mortgage and a HELOC, or a first mortgage and a judgment. Let's say you didn't pay a credit card and they took a $10,000 judgment against you, or you owe the IRS money and they took a judgment against you. Those loans have to be paid off if there's a loan against the home. It all has to be paid off, okay? Now, with a reverse mortgage, you generally need 50 to 70% equity in your home. Depending upon the age of the youngest homeowner, that's the key thing. The younger, generally speaking, the older the youngest homeowner is, and the lower the interest rate is, the more money we can loan as a percentage of the home. Those three factors are what we use to determine how much we can loan: the age of the youngest homeowner, the interest rate, and the value of the house, basically. So let me give you a quick example. If your home is worth $500,000 and you only owe $50,000 on it, that means you've got $450,000 in equity, which is plenty to qualify for. But if we flip it around and your home is worth $500,000, but you still owe $400,000 against it, you probably would, well, you wouldn't qualify now because we just don't loan 80% of the value. The most you could ever get right now, given the current interest rate environment we have, is I think if you're like 98 years old or something, you can get 60% of the value. Or is it, I'm sorry, I think it goes up to 70% if you're way up in your high 90s. If you're in your high 80s or 90 years old, we'll loan about 60%. In order to get 50% of the value, 50, you need to be about 85. For those of you that are 60s, early 60s or mid 60s, we're looking in the low 30% range, 32, 34, 36% of the value. So that means you need, in that case, you would need 68, 64, 62% of the of equity in your home, something like that, in that range. So the equity, just flip it back. The loan to value is the amount of money we're willing to loan, 30, 40, 50% of the value, which would mean equity needs to be 50, 60, 70% equity in your home, okay? What I tell people is we have to be able to loan you enough to pay off any existing mortgage on your home. So if we can loan you 40%, but you owe 50% on the value, well, you don't qualify yet. That's a key thing. Just because you don't qualify today, equity-wise, you don't have enough equity in your home, that does not mean you'll never qualify, obviously. Depending upon the interest rates and values of the home and just time. You know, if you were to call me back 3 years later and interest rates have dropped from 6% down to 4%, and the value has gone up by another 10% in that time period, it's very likely you could qualify because also you're going to be 3 years older. All of those factors play into the amount of money that we can loan. And it's not just the amount of equity you have in your home. All of those factors play into it. Okay, so keep that in mind. But another option that a lot of people don't realize that exists with reverse mortgages is something called the reverse mortgage for purchase. I've talked about this off and on. I've done whole shows on it. You can visit me online at reversemortgageradio.net. Reversemortgageradio.net is my website, and you can see there's a really good video testimonial from a couple that did a reverse mortgage for purchase. I actually went and met with them. They were interested in a reverse mortgage, but they explained to me they weren't totally happy where they were. They thought maybe they would like to move. They needed a newer home, something all on one level, and they just were not real happy with it. So that's when I told them about reverse for purchase. And they thought, tell me more. And I explained it to them, and they ended up doing that. So they didn't do a reverse mortgage at that time, but a few months later, they sold their home. This was, pre-COVID. This was 2017, 2018, something like that. And I also just closed a reverse for purchase last month, And the couple, they just wrote me a nice Google review on the website, or whatever they call it, Google reviews. And then I just closed one this week for another couple that they're very happy with the whole situation. Hopefully they'll write me a review or give me a video testimonial, one of the two. But it's a great program. People just don't understand it. Basically, you sell your old home. You have this big down payment, so you get $200,000, $300,000, $400,000. You put it down, and you could buy a $500,000, $600,000, $700,000 home. And basically, the reverse mortgage covers the difference of the money that you don't have. Or in a lot of cases, if you cash out with $500,000 and you want to buy a $650,000 home to move into, you would normally need to get a $100,000 or $150,000 mortgage. But with the reverse mortgage for purchase, you could basically put down less than the $500,000. We'd cover the difference. And of course, there's a lot of factors that determine how much we can loan, just like we talked about, the interest rate and the age and things of that nature. But we cover the difference with a reverse mortgage, so you don't have a mortgage payment. Of course, you still have to pay your taxes and insurance and maintain the home and all that stuff. But there's no actual principal and interest payment required on a monthly basis. Though that's very important to people. And then you can keep some of the proceeds from the sale of your old home as well. It's a fantastic program. So anyways, just let me know if you're interested in doing something like that, because it's a great way. That's what I plan to do here in a few years when I'm old enough and I decide that I'm going to move from my multi-level home that backs up to a very busy street that I don't want to retire in. So anyways, that's the key thing. The equity, like I said, is the second factor. The more equity you have, the more options are available to you. That's if you own your home free and clear, that's great. You have all kinds of options on how you receive the money. If we can just loan you enough to pay off your existing mortgage, there's still a ton of benefits to that, because you're saving whatever the principal and interest portion of your mortgage payment is on a monthly basis. Let's say, for example, your mortgage payment is $200,000 and we can loan you $200,000, just enough to pay off your mortgage. That's perfect, because that $200,000 mortgage has a $1,300 a month principal and interest payment. Now you say, well, what's the benefit of that? You're just trading your old mortgage for the reverse mortgage. There's no monthly payment required with the reverse mortgage. That means you can keep $1,300 in your pocket every month. You just gave yourself a $1,300 a month raise. And that would help to cover some of those increases in property taxes and homeowners insurance and food bill and medicine and gas and everything else too that goes along with home ownership and just living in Colorado. So keep that in mind. That can be a very big benefit to having doing a reverse mortgage, even if there's no money available to you after the fact, because you're going to keep that money in your pocket from the principal and interest portion. Okay, now let's talk about the third one, which is financial assessment. Sometimes people, they ask me, they say, wait a minute, Bruce, that's surprising. I didn't know that I had to qualify. I didn't think that there were any income or credit requirements for a reverse mortgage. There's still a lot of people who think of reverse mortgages as something you don't have to qualify for. But yes, you do now. In 2015, HUD, the Department of Housing and Urban Development, which FHA, the Federal Housing Administration falls under, made some important changes. And they were to protect homeowners and the reverse mortgage program in general. Let's start with credit. So we do have to look at your credit. We're not looking for perfect credit scores. In fact, we don't even look at your credit score exactly. Some people say, well, I've got an 800 plus credit score, and that's fantastic. I always say that's awesome. That's probably the majority of my customers. Sometimes people will say, well, I've got a 580 credit score. That does not automatically disqualify you. So most people are somewhere in between, high sevens or high sixes. If they've got a lot of debt maybe, or they've had a lot of inquiries, that can draw down your credit score. But I don't care about credit score. I care about, do you pay your bills on time? That's the main thing. And even then, what we mainly look for are, have you paid your property taxes and homeowners insurance on time, and your homeowners association dues? That's critical. There are people that they'll let that slide when money gets tight. I just closed a loan just this last week where the people were, they paid their own taxes and insurance. They just had a home equity loan, like a HELOC, and they paid their own taxes and insurance perfect for 10 years, but they had all kinds of trouble with the HOA management company. They had some medical issues too, and the management company switched a couple of times, and they had to call to set up a direct payment. The HOA people wouldn't take a check, all kinds of stupid stuff. And we wrote a big, long 2-page letter. They showed me proof of the medical issues that they had, and that directed, because the wife was taking care of the husband when he was ill, and it just caused a lot of stress on her. And now they're better, and they've paid on time for all of 2025, and it's on direct deposit. They got it squared away, and they're perfect now. So we were able to justify that, and we were able to do the loan without no repercussions at all. So that's one of the things. But if you pay those bills on time, but you've had a few lates on credit cards or even a personal loan or a car payment now and again, that's not a deal breaker. Okay. But we're going to get back to details on that. Let's talk about income. We do look at income. We look at something called residual income. A lot of people have heard debt to income ratio. That's what the forward world looks at. If you're getting a regular mortgage, they want to see debt to income ratios at no higher than 38 or 40 or 42% of the value, sometimes 50%. So in other words, half of your gross income has to be free after you pay your bills. We look at it a little differently with reverse mortgages. We look at residual income. We want to see how much money you have left over after we factor in your property taxes and homeowners insurance, because that's a requirement. Remember, there's no mortgage payment. So if we're saving you $1,200 or $1,300 a month in your principal and interest, that helps a lot of people. Most people, as long as you don't have a ton of debt or big car payments, most people will qualify just on Social Security. Now, there's some people who might only be getting $800 or $1,200 a month in Social Security, and they don't have any savings. That can be tough, especially if they have any consumer debt. That can be really tough now, especially because taxes and insurance are so high as well. We have to make sure that you've got enough money left over to pay your taxes and insurance and still live. So what we do is we take your net income. Let's say you make, between you and your spouse, you earn $3,000 a month in Social Security. And then from that, we subtract out your property taxes, your homeowner's insurance, your HOA dues. And let's say you've got a $400 car payment, and you've got also, too, we use utility bills. Now, we don't look at your utility bill. In Colorado, we just automatically factor in 14 cents a square foot is what we charge for utilities. So if you've got a $2,000 or 2,000 square foot home, we're going to figure your home or utilities are $280 a month. That's what we subtract from that $3,000 a month income. So we subtract all that, and you've got $1,500 left over. Well, that's plenty of money, because if you're an individual, you have to have $589 left over. If you're a couple, like in 2 people or more, if 2 people are living in the home, we have to factor in $998, and then it goes up if there's 3, 4, or 5 people in the house. Then it goes up slightly. So it might go from, I think it's no more than $1,200 is what's required if you've got 3, 4, or 5 people living in your home. Most people just have 1 or 2 people. If you've got, sometimes you're taking care of grandkids or something like that. That's the easiest way to do it. Now, we can also factor in loan proceeds as if you're taking it monthly. So let's say we do a loan, we pay off your existing mortgage, and there's $100,000 left over. We're going to count that $100,000, no matter how you take it. If we set it aside in a line of credit or whatever, we're going to count that as if it's income. We're going to figure what's called how long you're going to live in the home. And then we're going to factor that in based on actuarial information. We might figure you're going to live there 10 or 15 or 20 years, and we'll spread that money out over that time period. Or if you've got other investments, say you've got $100,000 or $150,000 in a some kind of investment account or IRA or an annuity or something, we'll do the same with that as well. Now, if you've got bad credit, or you haven't paid your taxes or insurance on time, or your income's really tight, or even just sometimes people are older. Let's say you're 80 years old and you don't want to. You've had the escrow account. Your mortgage company's been paying your taxes and insurance ever since you've had a mortgage, and you don't want to be responsible to pay for that because you're afraid you might forget, and you don't want to have that big bill every month for taxes or insurance. We can set that money aside. What we do is we take it away from the money that's available to you based on how long we think you're going to live in the home. We figure out, okay, your taxes and insurance are $3,000 a year. And you're going to live there another 10 years, we estimate. So we'll set aside roughly, we multiply it by a percentage and then set it aside. We might have to set aside $35,000, which is fine if you've got $100,000 left over. But if we can only loan you $200,000 and you owe $200,000 on your mortgage, well, you need every penny of it to pay your existing loan. And then if we have to set money aside because you've got bad credit to boot to pay your taxes and insurance on your behalf, then there's just not enough money for it. But everybody's in a unique situation, and so we'll look at that separate. We'll look at your situation and see what we could do. Okay? So now, before we wrap up completely, I do want to just bust a couple of quick myths. Because one myth we just talked about, people say, well, I've got bad credit, so I don't qualify for a reverse mortgage. Not necessarily, just like we talked about. Maybe we can't qualify you currently, but it doesn't mean we can't qualify you a year or two down the road, okay? With the life expectancy set aside where we pay your taxes and insurance, or if you can clean up your act on credit over the next couple of years, pay your taxes and insurance on time, then it's very possible. Also, too, you don't have to own your home free and clear. We can pay off any existing mortgage. And a lot of times people say, well, is it hard to qualify? No, it's not. It's easier than a conventional mortgage. So remember, to qualify for a reverse mortgage, at least one person needs to be at least 62 years old for the FHA-insured loan. You have to have enough equity in your home, and you have to qualify for a financial assessment. We look at your credit and income. Okay, those are the three key steps that you need to qualify for a reverse mortgage. Now, if you're wondering whether you qualify, your next big step is simple. Give me a call. Just give me a call at 303-467-7821. 303-467-7821, or visit me online at reversemortgageradio.net. reversemortgageradio.net. I can very easily run numbers for your specific situation. I'll look up values in your neighborhood and see if we can, narrow it down if you don't know how much your home might be worth. And then no pressure. I'm not going to try to sell you. I'm not going to try to talk you into anything, okay? Remember, a reverse mortgage isn't about what you give up. It's about what you gain. Peace of mind, security, and freedom. I always say reverse mortgages are intended to relieve financial stress, not create it. Okay, so thank you so much for joining me today on Reverse Mortgage Radio. Just remember, you need to give me a call, though. Okay, give me a call at 303-467-7821. I'm Bruce Simmons, your reverse mortgage professor, and I'll be talking to you next time. Have a great day.
Call Bruce Simmons today. Ask about his free Colorado Consumer Guide, 303-467-7821, or reversemortgageradio.net. Bruce will come to you anywhere across the Front Range to make sure you understand how reverse mortgages work. Regulated by DORA, NMLS number 409914. American Liberty Mortgage is an equal housing lender.